Welcome to the Economics of Real Estate, the show where we unlock the secrets and trends that are driving the market. Whether you're a buyer, seller, investor, or agent, we're here to help you decode how the economy shapes our next move in real estate. In every episode, we'll take the complex economic data and turn it into actionable insights, giving you the edge to stay ahead, make smarter decisions, and seize opportunities that others might miss. Think of it as your weekly real estate cheat sheet where understanding market shifts could be the key to your next big win. So if you're ready to outsmart the market and make the most of every opportunity, you've come to the right place. This is the Economics of Real Estate. Let's dive in. Matt, there's been some big changes in the world of mortgages and lending and CMHC. I think there's a lot of people out there with strong opinions and a lot of people out there that don't care or don't know one way or the other. And I know that you and I have been talking about it. We've been talking about it with some of our mortgage professionals. I think it's time that we jump in and start talking about, of course, for those that don't know what it is. And then for those that do know, let's start breaking it down and look at, like, what are the pros to this announcement? What are the cons? How can you use it to your advantage? And maybe what are some of the pitfalls? But ultimately, I think you and I have come to the realization that if we really take a look at this, and this is how we approach everything, how can I make this work for me?
Yeah. And you know what, it's critical to take a step back sometimes, let the news come out, process that news, see other people's reactions, and really sit back and think about really what's going to be the effect of a certain policy. And at the end of the day, policies really shape the future of a lot of things, assets, investments, real estate. So it's critical to kind of take a step back, look at the big picture and see where this might be headed. And I think we got a great show today to kind of show people, it's not all doom and gloom that you're hearing online, or that this is just another policy to prop up the government and to drown more people in debt. But this is actually an incredible opportunity for smart investors, smart first-time home buyers to get into the market now and capitalize on what's coming ahead.
Yeah, that's a great point. I love the idea that you talk about, hey, take a step back and read the room a little bit. See what other people are saying. Obviously, this is something that came out kind of out of nowhere in the sense of a lot of the mortgage professionals didn't get any advance notice that this was coming down the pipe. And even as they're inquiring to lenders and even CMHC at certain parts, they don't have all the details to share as of yet. So it's definitely been something we've been seeing kind of unfold and reveal itself to us as time has gone by in the last week. And I think that will hold true all the way up to December 15th, where we start to see this and beyond as we start to get more clarity on it. But at the end of the day, I love the idea of taking a look at it and like, how can I make this work for myself, right? How can I make this work for my clients? And the big one that I want to start with is some context. Obviously, they're marketing this towards, first-time home buyers. That's who they're targeting with this. I think they're also targeting, the new developments. They're trying to get some more housing starts going. They want people investing in new homes to add more inventory to the market. But as we're going to jump into on this next slide, we're not on track there yet. And I think that's why evaluating this for your clients is so crucial right now, because there are people that are going to need help. And if we don't take action today, 5-6 years from now, we're going to be in a harder spot. And so let me just cue us over here to our next slide. There we go. And so, Matt, talk to me a little bit about what we're seeing here in regards to the housing starts, especially in comparison to our growth in population.
Yeah. So on the left-hand side here, we can see the dark blue line is the population change. The light blue line is the number of starts for units. So we can say it's not uncommon to really to get ahead of the starts for population, but we've really blown it out of the water now. So, and then on the right-hand side, we'll see this is more GTA kind of numbers, where we're seeing from 2010 to 2015, the population growth and the starts. 2015 to 2020, population and the growth. So we've seen this massive spike in people coming in, but the starts aren't accelerating at that level. So, one of the key takeaways here is, housing starts are leveling as of this chart. Population is increasing at a very large amount. And let's go to the next chart, because what's important about the next chart is builders are actually not building as much as we need now. Applications are falling off a cliff. So what we know is future builds are not going to be there for this massive population boom that we're starting to see right now.
Yeah, when I look at it too, and I think it's great that we have both slides in here because this almost looks a little misleading where we're seeing the 4-year combination, right? We're seeing that it's okay, we're on track a little bit more than where we were 2015 to 2020, despite the massive change in population. But when you come over to this graph, you can see that these applications have been dropping on a year over year basis. And so at the end of the day, when we're talking about, the housing supply and the shortage and the concerns that we're having there, we're actually on pace now to get worse, not better, right? Yeah. And I think that that's something that's important. So we know that home ownership is going to get harder and harder as time goes on. So, okay, the government's given us something here that's supposed to help first-time home buyers. Let's jump in and take a look at what it is. And is this something that is beneficial, or is it that knee-jerk reaction of, hey, I'm just taking on more debt as I extend my amortization? So let's jump into that first. And you and I had this discussion in the car the other day talking about who is a first-time home buyer. And let's start right here, Matt, because this is critical in terms of, I think that there's people that don't know about point number 3 on here, maybe even to some extent point number 2. So why don't you jump in? Let's just first identify who is a first-time home buyer.
Yeah, so at least one of the borrowers on the application must be a first-time home buyer. But there's 2 other ways. If you and your spouse or common law had previously purchased the property, you sold it, you haven't lived there for 4 years, you are now officially back to first-time home buyer status. And then the second one is if you had recently experienced a breakdown in a marriage, in a common law relationship, it is possible that you can be a first-time home buyer as well. Now, I believe that either with the CRA or the lawyer, they need to assess whether you fall into that category, but that's definitely a question to ask a mortgage broker. So if you have had a relationship breakdown, talk to your mortgage broker and see, do you fit the 4th column here? Because I think most people out there and a lot of agents out there might only know that, you've never bought a property ever before in your life. That's what a first-time home buyer is, but that's not true. These other 2 sections, a lot of people fall into and they have no idea. And as a first-time home buyer, again, you get to use the government incentives that you got to use before. You can reuse your RRSPs as a down payment on your property, as well as the first home savings account that just came out. You can use that one as well to help you with the down payment on your new home. We'll talk a little bit about the change for the insured mortgage to go from 1 million to 1.5 million, but that's not really going to affect the market as much as I think the 30-year amortization will. So the federal government is now allowing 30-year amortization periods for all first-time home buyers. And here's another big one, as well as anyone. Doesn't matter if you're a first-time home buyer or not, purchasing a new build home. So this significantly expansion from the August 2024 policy, which first-time home buyers only got 30-year mortgages if you were buying a new build property, whether a new build home or a new build condo. So now it's any home for first-time home buyers, and it's new builds for anybody, regardless of how many properties you've purchased before. You can now qualify for the 30% as well. And then, like I said before, additionally, starting on December 15th, the mortgage insurance eligibility has been extended to homes priced between 1 million and 1.5 million. So to put that in perspective, in the old system, you'd need $300,000 down payment on a $1.499 million property. Now it's only $125,000 that you need down.
Yeah, and that's a big difference. Like, that's a substantial difference, especially when you're looking at first-time home buyers. They're trying to save up that money. They don't have that equity built in by any means to help up that down payment. Now you can work with that $125K down in the example that we're talking about. But before I do want to talk more about the million to now the 1.5 and where we think that will help and the difference that it'll make. I want to talk real quick. Why do you think the government is now making that change that this is applying to new builds across the board?
Well, I think the first thing for new builds across the board is we just saw in that clip, that chart before, applications are falling off a cliff, and they need to start sparking interest in the market. At the end of the day, it costs a lot of money to build properties. There's a lot of tax baked into new properties as well. They're extremely expensive to build, and they need to bring incentives into the market to get more people buying new builds. Because at the end of the day, if we're going to have a massive population boost in this over this decade, we also need a massive housing start boom
Yeah.
as well to fill these gaps. And if we're seeing applications fall off a cliff, we're never going to get to the targets that we need to meet.
Yeah, I think that that's just important to acknowledge, right? Because we're looking at those starts and we're talking about, hey, we know supply and demand is a very, very core element to how our real estate market works, right? We've got some outside influences right now with inflation that drove up the interest rates to kind of counteract that. And obviously, we've seen the impact that that's made on the market. And as that comes back around and as we start to distance ourselves from all the impacts that COVID had made, you got to remember that that is not that long ago. We're still dealing with repercussions from decisions that were made during that time, the amount of money printing that happened during that time. As we get further and further from that, we still have an issue of we've got a lot of people and not enough housing. We're seeing those starts decline. We got to start incentivizing builders to build more and more people to be buying that type of product.
Yep.
I think that's just the reality of where we're at. And so, talk to me a little bit about, of course, this is applying to people that are putting down less than 20%. It's our insured mortgages, right?
Yeah. So this is just comparison between a 25-year mortgage versus the new 30-year mortgage this is for a first-time home buyer. So if we look at the example between a 25-year and a 30-year mortgage, let's say that we're buying a property worth $800,000. You're putting $160,000 down, and your total mortgage is $640,000. So for the 25 years, the rates are typically about 4.74, and for the 30 years, you're looking at around 4.94, just for our example going forward. So the monthly payment change from the 25 to the 30 year is $231 less per month. Now, it may seem like it's not a big decrease in monthly payments. It helps, but also what you're going to be able to qualify for price-wise is going to dramatically change as well. So it does allow people that are right on the fringe to be able to potentially get to the housing prices that they need to get into the market.
Yeah, I think, Matt, the important thing here to remember is this is just another tool in the tool belt for realtors and buyers to use as they need. And it could be the difference of getting into home ownership or not. I mean, sometimes we've seen it where as soon as you go from a condo town to a freehold town, it prices somebody out of the market, even at the same price point, just because of those monthly maintenance fees, which could be that much or less even. So, yeah, definitely just another tool in the tool belt. And that $231 can make a difference. So after looking now at the monthly payments and the breakdown there, I think it is important to note what's the difference in the interest paid. Obviously, over the span of the full mortgage, it's going to be a higher number. But I think that one of the things that people haven't really considered with this new option out there is that it can be a short-term solution. We do usually take these on the 5-year term. So it's not like you have to realize the total difference in interest paid. But let's look at it in 5 years. Say it's realistic for you that in 5 years you will be in a different position. We're going to talk about equity as well, but even just financially, maybe with your job, you might be earning more money. And so if we just take a look at what's this going to cost me for 5 years to get into the market. So talk to me a little bit about this, Matt.
Yeah, and no matter what year or length of a mortgage that you're getting into, whether it's a 20 year, 25, a 30 year, it's the first 5 years typically where you're going to pay the bulk of the interest.
Yeah.
The banks are kind of getting their profit up front. So just because we're in a 30-year, yes, over a 30-year period, you're going to significantly pay more money in interest. But here's the thing. We're trying to tell you that there's an option here to get in. And yes, over 5 years, you're going to pay about $8,500 more. But as we proceed in this, in the slides, we'll kind of show you it might be worth it to take a little bit of a hit now for longer term success. So as you see with the 25 to the 30 year, it's only $8,500. I know it's a lot of money, but over a 5-year period and over a 30-year period, when you see the numbers later on, it might be worth it for some people to do this.
Yeah, and I think this is just a case study on numbers that we were playing with, but it depends on where you're looking at. If you're trying to max this thing out to 1.5, I mean, you still got to qualify at that point to get it. Nonetheless, the numbers will, of course, will be higher based on more that you borrow. But for something that's starting out new and was starting at maybe a little bit one of those lower price points, just being able to extend, that's a small cost, I think, for being able to get into the market and look at it that way. And then I think obviously this is the main reason why we want to figure out if these tools make a difference for us, if we can utilize them, if they serve us, because at the end of the day, we're trying to make smart real estate decisions that are going to benefit our lives. And talking about net worth after this time, I think, is so important. So why don't you start with us here? We're looking at what I can see here, the 25-year mortgage at a 2% price increase over the span there. So talk to me a little bit about it, what it is after 5 years.
Yeah, so let's say that you've gone out, you've got a 25-year mortgage, and let's assume that this is based on the sale that we just talked about. So let's say the price either goes 2% or 3%. These are very conservative numbers. We know that inflation typically on a yearly basis is 2%. It can even be 3%. We also know that housing is a finite thing in this country. So it's not uncommon to see a 3% or even more per year, but let's just go it off 2 and 3%. So the property and value increase over that 5-year period would be $83,265. The mortgage principal pay down would be around $75,000. Mm-hmm. And so the total net worth over the 5 years that you have now accumulated is about $159,000 or around $32,000 a year. Now, the 3% model, you're looking at a property value increase of $127,500, the mortgage pay down of around $75,500, and then your total net worth is potentially as high as $202,000, $203,000, or $40,500 per year of equity that's building up in this property. So when we go over to the 30-year, we're going to see that your property in value has increased $265,000. Your mortgage pay down is less. It's $52,789 as compared to, I believe the other chart was $75,000.
Yep.
But like your total net worth here on the 2% range is $136,000 or $27,000 a year. So that's $4,000 a year less. Okay, but you're still, the net worth there is almost $30,000. But let's add in that you're also paying $13,860 less. So now that brings you up to almost $30,000 a year of equity that's going into your property, or money that's going into your pocket that you can reinvest in something else. So really the difference is only around $2,000 here of equity over that 5-year period. And then the 3% around the same, it's $127,000 of property value, $53,000 mortgage pay down. So now your total net worth is $180,000 over that 5-year period. And if we look at the savings of the $13,860 over the 5 years, you're looking at $38,815 per year in equity that you've built up in the 30-year, as compared to $40,500 in the 25-year. So it's not that big of a difference between the 25-year and the 30-year. So I think people out there need to stop looking at the doom and gloom of this and as an opportunity to say, hey, the payments in the beginning for this property are around what you would pay for a townhome in a lot of areas.
Yep. Yeah.
and you could be, and you're not building any equity
Yeah.
over that 5-year term. But hey, this opportunity just came out for you, and you can potentially make on the high end, and these are still even conservative numbers, $180,000.
Yeah. Yeah, I agree. And it's especially when I come back and I'm looking at the monthly payments that we're talking about here, you're right. Like that's rent. That's rent for a lot of people, right? So where are you putting your money? If you're going to be spending that money on rent anyways, take a look at what you can do for yourself in terms of the equity growth over time. And the other thing that we wanted to talk about briefly there, Matt, before we wrap up today, was the changes that we've seen. Like obviously, we're talking about 2 and 3% price growth here, and when we're not in the midst of a correction, those are very conservative numbers. I like those numbers. I think they're very healthy numbers. I miss the years, in the early 2010s and even like early 2000s where we were seeing, moderate price growth that was very sustainable feeling. And we, like I said, we're these are conservative. We've seen in recent years where we're seeing much more than that. But now we're in the state of a correction and we're wondering, okay, how much more is this thing going to slide? And I want to throw it to you with the idea of like you and me crunched the numbers and we looked at from the peak of 2022 to where we are right now on the Toronto Real Estate Board. That's a drop of 19.5% in terms of average price.
Yeah.
So talk to me about where you think where this market's going to go. And we're looking, the outlook is more shortage. Our starts are down. Our population growth is up. We're trending in the wrong direction to fix any type of supply issue that we're having with housing. And I think you can't help but look at that percentage and say, like, the big correction has happened.
Yeah, I agree. The correction has happened. Now interest rates are starting to work their way down. And do we have maybe a couple more percentages to go? Maybe we do. I can definitely see that. But in the grand scheme of things, when you look at real estate over 5 years, over 10 years, like if saving a couple $1,000s now potentially isn't going to matter in 10 years.
Yeah.
Because at the end of the day, the 2 and the 3%, those happen regularly. What we've seen in the past, we've seen massive jump ups, and we know that interest rates are going to get slashed over the next year. So we know at some point, the cost of borrowing money plus the increases in pay that a lot of people got over the pandemic are going to come to a head and prices will start to reaccelerate. And you don't want to be waiting too long. And then all of a sudden you've missed that 10%.
Yeah.
You've missed that 15% because you were thinking that another 10 or 20% was going to go down in the housing prices. But ultimately, there's not enough homes for the amount of people that live in this country, and it will reaccelerate at some point. To what extent, we don't know until we see, but I can safely say that for sure 2 and 3% per year over a long stretch will be averaged in.
Yeah. And, quick shout out to Michael Tuff in our office that recently posted a video talking about trying to time the bottom of a market and give the example of the bouncing ball and like, did you get it? Did you get it? And the reality is trying to time the bottom of a market, everybody that tries to do that, like 90% of them are missing. The ones that got it by fluke because you don't know when we turn around. We turn around very quickly in the GTA housing market historically. It's there and then it's missed, right? So do you believe we're through the worst of it? Absolutely. Could a little bit more softening come? Yes. Is that going to impact you on your purchase now for the next 5 years? No. So I think that it's important to just take note. Does this product work for me? Does it make sense? We've broken down the numbers where, yes, there is opportunity there for you. This is our case study. Everybody's going to be a little bit different. But if you know that housing is only going to get harder to get into and you've got a way to do it now because now they've given you the option to qualify for a little bit more because your monthly payments are lower, that's something to consider. And don't worry about realizing the loss of all this added interest that you're going to pay because the goal is you shouldn't be doing this if you don't have an exit strategy for this 30-year AM. In general, I don't think anybody should be planning to pay off their mortgage in the full 25 years. When you look at how much interest you pay over a 25-year term, let's call it, you're paying a ton of interest. You're almost buying the house 1.5 times after all of that. So I don't think that anybody that's that's out there stating, oh, this is just a way to add more debt. Yes, that is a reality of it. But if that's how you're approaching it, you're missing it altogether, because you shouldn't be approaching your mortgage standardly at that same method as well, because you are going to pay a lot of interest. You've got to find ways to prepay to get that thing down if you want to make smart financial decisions. This can be a great short-term fix to get you into the market, and just make sure that you're planning an exit strategy.
This is basically a door that's opening for some people, and you need to walk through that door, and there is going to be ways in the future that you can start to pay off that mortgage quicker. But this gets you in the door, because if we start to reaccelerate again, you're left behind, and you weren't able to get into the door. And one thing that I've thought, for some people, it won't be for everybody, but for the people that can afford it, going potentially on a variable rate mortgage right now and then locking in next year on a lower fixed is a very cheap way to not maybe tie into the high 4.7, 4.8 mortgages right now, but potentially get into a 3.5 next year. And by using this 30-year mortgage to get your foot in the door, you could even have a cheaper mortgage next year, so that the interest that you're paying over the 5 years is actually going to be less than had you have locked in a 5-year mortgage. But you need to talk to a mortgage broker about that. But there are options out there for people who are using their head and who are seeing the opportunity right now.
Yeah. I think that's our final takeaway for today. Is we want to make sure that you guys are having these conversations, because there are ways out there for you to make more money through real estate and through some of the tools that are out there, and aligning yourself with the right resources and the right advisors. You guys can make a lot of money, and you can mitigate a lot of the costs that come along with carrying these big mortgages in today's rates. So make sure that you're having those discussions. Keep tuning into the Economics of Real Estate, where we break this stuff down for you. Our goal is to find opportunities in the market for you, to evaluate the policy changes so that you can find out, how can I make this work for me? And that's us in a nutshell. So I'm Dylan, that's Matthew. Thank you so much for joining us. We hope to see you again next week.
Bye, guys.